today we are getting down to business. We're going to talk about a rather serious topic, 2024, the recession. It's coming. Let's not pretend it isn't. In today's video, we're going to talk about some market predictions that a lot of important people and institutions have made. I'll show some easy to understand charts. I'll share some tips on what we can do. Truth is that this year we already entered a recession. It's just that it wasn't made official. Next year though, it's going to be made official. This year was the year where we made as much money as possible to prepare. Things are going to be a lot more challenging from here on out. Now, I wish I was joking, but I'm not. Now, maybe I'm too defensive and we enter the biggest economic boom that we've ever seen and enter a new era of prosperity. Right. Now, I'm going to have a lot more macro analysis, investment strategies, and wealth building strategies to help you emerge stronger than ever. So make sure to subscribe here, turn on the bell, join me on Substack, Twitter, and Instagram, and let's get started. Your comments are super important. So as we enter one of the most pivotal moments in the cycle, please share your thoughts below. See, folks, one of the things that we have had to deal with that has been a massive problem for a lot of people is the higher interest rates over the last 18 months. With the Fed having raised rates from 0% to 5.5% for the Fed funds rates, everything from credit card APYs to auto loans to mortgages have all skyrocketed. And because the US is a debt-driven economic model, higher interest rates are very problematic for a lot of sectors in our economy. The system hasn't broken yet, but it doesn't mean it won't. But here's the good news. After the fastest interest rate hikes in history, we have seen Wall Street now come out to say that the Fed is done. And they're done raising rates and that the rate hiking cycle is now over. And we can see here in this chart that there is an overwhelming majority of Wall Street participants saying the Fed has finished their rate hiking campaign. Because everyone sees rate hikes being over, a lot of people are breathing a sigh of relief that the worst is behind us, and that has made a lot of people say that a soft landing is now the main expectation. And herein lies the problem. You can see that there is a difference between what people say and what people do. Now, people say that a soft landing is now the base case, but what's the golden rule in finance? It's to follow the money. And right now, what does Wall Street see as its most confident area to park their capital? Bonds. Now let that sink in for a moment. As I shared in a recent Substack note, if we're going to get a soft landing, the biggest beneficiary is going to be stocks, not bonds. The fact that Wall Street is positioning in bonds is a sign that their capital is positioned for a hard landing, not a soft landing. In other words, they believe in a soft landing, that's what they say, but their positioning with their capital is in bonds, and that's designed to benefit from a hard landing. Now, generally speaking, bonds perform best in a deflationary environment or economic recessions. During economic growth periods, stocks far outpace bonds. Now, the fact that Wall Street says that they believe in a soft landing, but they're parking their money in bonds is a classic example of, do you believe what I say or do you believe what I do? Now, I'm personally going to be following their actions closely because that is the clearest signal to me about what they're truly thinking. Look, guys, it's incredibly important to not look at the stock market as the barometer of consumer health. The stock market is a place that is only participated in by 61% of people here in the US. And even then, most of the gains in the markets are concentrated in the upper class among society. Now, on my part, I've done my best to share many winning ideas inside my Substack, and we've had a very good year together inside my community. But I view this year as the year where we save up financial ammunition for a rainy day, if you know what I mean. Because that rainy day is coming very soon. You see, the US economy is 70% driven by consumer spending. And right now, the consumer is borrowing from the future to meet today's needs. And we can see that credit card balances have now ballooned to 1.08 trillion. And just 6 months ago, this balance was about 850 billion, 900 billion. And at this trajectory, and at today's credit card APRs of 22 to 25%, simple math suggests that credit card balances could reach 1.3 trillion to 1.5 trillion by the end of 2024. And in this context, a growing number of hardworking people are living paycheck to paycheck, and that number currently stands at 60%. This figure was about 50% a year earlier. So we can see that there are some disturbing trends forming underneath the surface. Not only is the aggregate number of people struggling to get by, but the credit card balances are also growing in the background, and this is unsustainable, and eventually there will be a large drag on consumer spending in the future as consumers get tapped out. Now, people who are saving wisely, taking advantage of deals, promotions, and investing for the long term in liquid assets are in the best position to succeed. Now I want to take a moment to talk about our video partner today, Mumu. During these challenging economic times with real estate trends on the decline, finding a stable method for asset growth is an important concern. Mumu is a Silicon Valley-based online brokerage where 20 million customers invest in stocks, options, and ETFs at zero commissions. One of the biggest differences between Mumu and other brokerage firms is that they offer 5.1% APY in their cash sweep program. Existing users can enjoy the same rate by either depositing a minimum of $500. This rate is actually higher than some of the interest rates that I'm earning in high-yield savings accounts. Now, this cash sweep program is FDIC insured and there's no minimum deposit or balance requirements. If you are a fundamental investor, within the Mumu app, there are features that are quite helpful, such as company fundamental reports as well as valuation data. The company's profile, historical and current PE, as well as institutional holdings are displayed. Wall Street price targets are also shared so that you can see what the sell-side analysts are thinking about. If you're more of a technical analyst, there are up to 60 levels of bids and asks, short sale data, capital order size, and capital trend intraday. The charting tools on the Mumu app are also very intuitive to use. There's currently an awesome welcome bonus for new users where folks get anywhere between 5 and 15 stocks by depositing between $100 and $1,000. There's also a transfer promotion where users receive up to $400 in cash rewards by November 30th. Doing so would really support our channel here, so get your free stocks and make an account on Mumu, as it's a very helpful investment platform. Now, back to the video. Another real-time metric that we can watch is that Fidelity reports that there is a growing number of hardship withdrawals from 401ks. And why are people doing this, you might be thinking? Well, the top two listed reasons include avoiding foreclosure, eviction, and medical expenses. This is why I think the real estate industry isn't as healthy as the current surface level prices make it out to be. The truth is that many people are struggling to pay their mortgages here in the US, even more so in Canada, and that 401k hardship withdrawals represent a real-time metric on holding on to home ownership in the context of a much tougher job market. Now, it's worse in Canada as housing prices have actually declined nearly 20% from their peaks, and with the Bank of Canada not imminently cutting rates, many Canadian investors are finding that the rents that they're charging in the market are not covering the mortgages that they are now responsible for. And on the ground, inside corporate offices across the world, the tone continues to put a pause on additional hiring. And as we head into 2024, we can see that 92% of employers are expecting additional headcount reductions. Now, the job market is fine for people who are currently at companies that are positioned well in their industries, but if someone has recently been displaced from work, I'm sure that you'd agree that trying to get back into the workforce is now a very serious challenge, especially for white-collar workers, mid-level professionals. I mean, if you work at McKinsey or graduated from Harvard Business School, then look, you have nothing to worry about. In fact, you are king of the job market jungle. But not everyone works at a market leader, and not everyone attended an M7 MBA. Now, I've been listening to a lot of earnings calls this past quarter, and one theme that I keep hearing from companies across different industries is that streamlining costs is their top priority, and that headcount growth is reserved only for departments where they see the most promise, like AI. Now, based on what I'm seeing at college campuses, there is an uptick in entry-level roles to fill junior staff positions at Fortune 500 companies, but companies are thinning out their middle management roles, and that means people with, say, 6 to 9 years of experience are the most vulnerable in this environment. They also happen to be the most important cohort in our economy because most folks who have 6 to 9 years of experience are the people who buy high-ticket items for the first time, such as auto and home. And this cohort will be entering a more contested environment in 2024. in my opinion. Now, companies are reshuffling their workforce to have a lighter cost structure by having more junior analysts and keeping the most senior people who source deals and bring in revenue. Middle management is increasingly at risk. But there is a solution to all this, and as I've talked about all year, every day, every week, every month, on Twitter, on Substack, on Instagram, this environment has only strengthened our resolve to grow and adapt. So the biggest bet that you can make in 2024 is honestly a big bet on yourself. Not the market, not necessarily stocks or bonds or real estate, a big bet on yourself. Every 12 months offers us an opportunity to shape our future. And this year, I learned the power of options as a long-term, sustainable way to increase my own income and returns from markets across different cycles. And I fundamentally think that this new skill has been a game changer for me. Ultimately, this year served to be a big reset for many industries, for many people. And unofficially, there was already a recession. It just wasn't made official, but it will be made official in 2024. Economic and market dislocations, though, have almost always been an opportunity to get ahead if you've prepared appropriately. So let's make 2024 your best year ever. I will be here to help. Thank you so much for your support. Leave a like if you enjoyed this video. Please share my work. Please subscribe to me here on YouTube. More investment strategy on Substack, Twitter, and Instagram. See you next time. Thank you to Mumu for partnering with us today and offering all of my friends here such generous offers.